this action Friday, the tone from the Fed, some of the M&A, the levels today are making you feel more constructive or not?
A bit more constructive, but honestly, we remain in a cautious stance, and we're concerned really about two main issues. One is around peak earnings, or the renormalization of earnings that many people have talked about. And then the other is, as you know, DoubleLine has a view that rates likely will continue to drift up, and so we're worried about the pressure that will place on multiples across the board.
So the relief we're sensing now with rates, you believe, is ephemeral?
I think so. There's a lot of pressures that we see in terms of the oversupply, the deficit spending, et cetera, that will continue to put upward pressure on rates. And I think that's something that you need to pay attention to as an equity holder when you're thinking about how selective you are and what types of multiples you want to actually pay for stocks.
Is there a sense then that from the Fed that they are willing to pause, but not because they necessarily want to?
No, I think it's appropriate that they pause. I think that the issues around the rates really have to do with certain things that are outside of the control of the Fed. And so we don't expect, barring a major recession, and we should be clear that we don't foresee a recession, that the trending upward in interest rates will put pressure on multiples.
Jim, it's a big week for tech. The Consumer Electronics Show kicking off. We're going to hear from Ginny Rometty at IBM. We're going to hear from Lisa Su at AMD and others. But it's kind of unclear where the next leg of growth in tech could come from. There's talk around 5G and the Internet of Things. If tech is going to have to continue to lead the markets higher, is there enough there for tech to do that?
Well, tech doesn't have to leave the market higher for one thing, but when you look inside technology, and really we look across the spectrum inclusive of biotechnology, clearly what we are seeing is a secular change where technology is likely to almost always already be a leader in terms of market momentum and also market returns, whether we're talking about upside or downside protection. I mean, there's no question in our mind that in this kind of marketplace, you almost have to throw out your classic economic textbooks and go straight to the classics. This is a market only Sisyphus could love. We think that earnings and fundamental economic data, low interest rates will continue to allow the market to roll up on good days, only to be rolled right back down the hill when fear-driven and event-driven factors weigh in.
Jim, Bank of America out with a note today arguing that Apple's revenue guidance is a warning about both U.S. and Chinese growth going forward. Do you agree?
I do agree. I certainly found the news last week coming out of Apple to be troubling, not just in terms of Apple specific related, but also in terms of how China may or may not be able to orchestrate soft boycotts on goods and services. It is a warning that I had not really thought through nor thought of until just last week for virtually every business doing business with China.
Emidio, I'm looking at some of these notes here. It looks like you're making the case for value investing right now.
That's correct.
I feel like we've been having this conversation on CNBC for quite some time.
Right.
Oh, the shift from growth to value. Why do you think that's happening now? Why is now the moment?
Well, you have to understand that the macroeconomic factors, the QE program, really supported growth. It's not the only reason that growth has done so well, but it's a major reason. And we're now at a point where the macro environment has shifted, so we believe that it's finally time for value stocks to start to outperform.
What looks like value to you right now? What would you categorize as that?
We're seeing opportunities in healthcare. We like some pharma names. AstraZeneca in particular is a name because it's focused on immuno-oncology. That's an area that we like. We like managed care companies like Anthem. There's been a lot of bad news priced into those names, and we think with the consolidation that's occurred, we're hopeful that those names will start to perform better.
One thing about this particular week is we're all on alert for more pre-announcements for Q4 earnings that we'll start to get next week. The concerns you're talking about regarding rates and credit, will those be reflected in sort of micro, general corporate commentary on earnings prints?
It's possible.
Is it too early?
I think it's hard to make that call, so it could be too early. I think that the trade is a bigger issue that we're looking at right now in terms of risk of pre-announcements.
Jim, I'll put the same question to you. Do you think we get more pre-announcements? Do you think the tape is more negative than currently expected going into Q1?
There's a lot of
Or
negativity
Q4 earnings,
priced
I should
in.
say.
Yep, Q4. There's a lot of negativity priced in. We'll definitely be paying attention to guidance in particular on a going forward basis, understanding, of course, that guidance is going to have a lot of clouds of unknowing relating to potential trade war issues in particular. But we do think that earnings will continue to help drive the markets as they have done. We do not expect no earnings growth. We certainly expect slower earnings growth. But that's a market where active management and stock pickers can come to the fore, not a market where buying whole market indexes looks like a prudent move to me.